Let's look at the decision framework here. We prepare financial statements, so the accountants do that. Okay, we did all the transaction analysis, we've got all these data, boil it down. We've got ourselves a balance sheet, income statement, and statement of cash flows. Now we're going to analyze those financial statements. That's what we're talking about during this discussion. Often it'll be the case that analysis of the financial statements will point you to other places where you need to gather additional information. Often the most useful role of financial statement analysis is to tell you where you need to go and find out more information. You're then going to make your decisions and implement those decisions and then see what happens. Observe the results. Those new results will result in new transactions, which will then feed into new financial statements, which you'll then analyze. And that'll point you to gather other information, gather additional information. You make new decisions, you'll implement those and see the results, and you keep going around and around. The key thing is this. Yeah, we're talking about accounting here. Our focus in this course is on accounting and the financial statements, but remember that preparing the financial statements is just a first step of a long series of things, of business events. Financial statements are just an input into a very important business process. So remember that. Preparation of the financial statements, pulling together the balance sheet and the income statement, statement of cash flows, just the first step on an exciting path. When we're doing financial statement analysis, especially when we're computing financial ratios, remember the one that I told you, net income divided by sales, called return on sales, how many dollars of net income are left over from every $100 of sales? We want benchmarks to which we get this number. Let's say that this number is 2%. No, let's say that this number 7%. Is that good? I have $100 of sales, pay all my expenses, I'm left with $7 of net income. Is that good or bad? Well, I need benchmarks. Let's look at the same company for last year. How did they do last year? Last year it was 10%, the year before it was 12%, and this year it's only 7%. That's horrible. That's a lot different than if last year it was 3%, the year before it was 2%, and now it's 7%. That's great. Also, let's look at other companies in our same industry, and that'll give us an idea. Other companies in our industry are at 4 or 5%. We're at 7%. That's great. So we need benchmarks. For example, this 7%. If I went up to Walmart and said, hey, your net income divided by your sales this year is 7%, they'd have a party. They'd declare a holiday and a celebration because they're usually a little less than 4%. So 7% would be awesome. If I went to Microsoft and said your net income divided by sales this year is 7%, they'd all have heart attacks because they're usually up in the high 20s, low 30%. So right around 30%, this would be a catastrophe. So you got to have appropriate benchmarks. Same company over time, other companies in the same industry, and how are they doing? Benchmarks are important to do appropriate financial statement analysis.